Greetings, fellow investors. I'm Matthew Cochrane, a lead advisor at 7 Investing, where it is our mission to empower you to invest in your future. We do that by providing monthly stock recommendations to our premium members and educational content that is freely available to everyone. What is going on in the markets? Right now, up is down, down is up. Cats and dogs are living together. Growth stocks are being hammered and value stocks are thriving. Joining us this week to help us walk through these challenging times is Tobias Carlisle. If you don't know, Mr. Carlisle is the founder and managing director of Acquirers Funds, and he's a podcast host extraordinaire. If you don't listen to the Acquirers podcast, where Mr. Carlisle interviews investors and hosts his weekly roundtable discussions called Value After Hours, you're sorely missing out. It's probably besides 7 Investing, it is my favorite podcast. I listen to it every single week. I'm not just saying that. I actually do. Toby, welcome to the show.
Thanks, Matt. That was a really kind introduction.
Well, it's very true. It's very true. So like, let me set the stage here a little bit, Toby, and I'm going to try to do this as smoothly as possible. But so right now, this is a recent Bloomberg article that appeared last week. Number of Nasdaq stocks down 50% or more is almost at a record. A near record of tech stocks have plunged by some 50% in an echo of the dot-com crash. Roughly 4 in every 10 companies on the Nasdaq Composite Index have seen their market values cut in half from their 52-week highs. Later in the article, it says, another way of thinking about the tech wreck. At no other point since the bursting of the dot-com bubble have so many companies fallen like this, while the index itself was so close to a peak. They interviewed this analyst. I forget what firm he's from, but he goes, valuations are at historical highs. Companies are raising billions based on fairy dust, and the Fed is signaling a tightening cycle. All of these are scaring investors that were on the cusp of a repeat of 1999 to 2000. And Toby, to be fair, like a lot of the software stocks that like people at 7 Investing, like a lot of my fellow analysts and myself favor, are not doing well. This is the ETF IGV, which is I think this is good enough to use as a rough proxy for software stocks. And it's down. It's like the other day, Bespoke Investing like tweeted out like it's officially in a bear market now. It's down 20% from its highs after a historic run, right? I mean, like not just since the COVID bottom, but the last 5 years, it's outperformed the S&P 500 by an awful lot. But if you look at like its falls, and what's interesting about this one, and I know this isn't news to you, but like, there's basically 3 times in the last 5 years where it's fallen by 20% or more. And in late 2018, which I remember vividly, that was a bad correction for my personal portfolio. And of course, March 2020, during the worst of the COVID. And now, but what's interesting about now, Toby, is that like, unlike late 2018 and unlike March 2020, the S&P 500 is not falling either, this time. Like, software stocks fell more than the S&P 500 in late 2018, but the S&P 500 was still falling. And in March 2020, it actually fell less than the S&P 500. I think they just kind of turned that corner a little quicker. But this time, the S&P 500 is only, it's pretty close to its all-time highs. And the S&P 500 is not falling, but software stocks are. So what's going on?
Yeah. Look, I've been saying for a little while, we should discuss my biases first. My bias is that, I'm a deep value guy. And so I have not covered myself in glory since about 2018, where we've been going backwards while the market's been going up. And earlier than that, you can really trace it back. It's a much longer period than really since 2015. We were just sort of keeping up with the market. And then it's been a very rough run. Full cycle, I think value has still done okay. When I say full cycle, I'm counting from the bottom of 2009. I don't know if folks agree with me that is the full cycle, but that's what I think the full cycle is. Okay. So what I have observed is that the growth stocks have got extraordinarily expensive. Let's define growth stocks, because every time I say growth stocks or value stocks, the first two things
I think
that
that
people
actually,
say
I think that would be really helpful to define when you say value, when you say growth, what are we talking about? Yeah.
People always say, so let's talk about on a simple ratio basis. So let me get this out the way at first, so that the first comment under this podcast isn't Buffett says value and growth are joined at the hip. That's absolutely true. No dispute from me. They are. It's all on a continuum. But when you think about, if you just think about a simple model that we like, Gordon dividend discount model, Gordon growth model, those kind of, which basically has some flow. Typically, it's a dividend divided by the discount rate less the growth, right? So the idea is, in the market, it's very difficult to find arbitrage opportunities, which is something that's just obviously mispriced. And so if you make that assumption, which it's right most of the time, it's obviously you and I are hunting for things that violate that model. And that's how we expect to sort of deliver some better returns than you could otherwise get in the market. But for the most part, most stocks are pretty fairly valued. And when you find them and they're missing that, they're out of whack according to that model, it's because something's happened to them, and you've got to do a little bit of work to kind of figure out whether that is in fact sustainable. But the difference between the value and the growth is simply that the growth factor. So when you find something that's trading at a very high multiple, according to that simple model that we discussed before, that Gordon growth model, which is just D over R minus G, the G has to be much bigger. Like that's what the market is implicitly saying when these multiples are very high. So that is the definition of a growth stock. It's something that has a very high multiple, and the reason is because that might be entirely legitimate that it has a very high multiple, because it has a very high rate of growth. And a value stock would have a lower multiple and commensurately lower rate of growth. And that's how you get the divergence between the two. And that's what I'm talking about when I say these things. Now, the reason that I have tended to stay away from growth stocks and have tended to favor the value stocks is that we are, as investors, as a cohort, all of us tend to be too optimistic about rates of growth. They're just not sustainable. Buffett always says growth sort of becomes its own anchor. You eventually saturate the market. Now, what has happened over the last 5 years that is unusual is some of these very big companies, Amazon, Google, Microsoft, and so on, have continued these exceptionally high rates of growth that defy the base rates. And when I talk about the base rates, the best way to think about it is, or the best way to sort of discover what those base rates have been, is to go and look at the work that Michael Mauboussin has done. He has collated all of the data that we have going back as far as we can. It's a Credit Suisse report. When he was, I'm not sure if he's still there, but when he was there, that was the work that he was doing. You can find these base rates, and it shows, what is a company that has $100 billion in revenues, what is the likelihood, and these are all adjusted for inflation too, what is the likelihood that thing can generate a 15% rate of growth? And it will tell you, and I don't know the numbers off the top of my head, but it will tell you that they become, vanishingly small. It becomes like one or two or none. At some point, they get too big to deliver these very high rates of growth. And so I have always historically built into my models these more conservative assumptions about what these expected rates of growth can be. Now, what has happened is that these bigger companies, possibly because the internet, the web, allows a different type of business to thrive. Maybe these software businesses are different businesses where essentially the company works on one product that it can deliver, basically costlessly. The marginal cost is zero, and then they can have an virtually infinite number of users on these things. It's not actually infinite, but
right.
You know what I mean?
Basically, like Microsoft Office, like the cost
right.
of making one is the same as
right.
the cost of making a million. Like there's
right.
but Ford, if they make one car, the cost is obviously a lot less than if they make a million cars, because of all the materials that go into every car.
And in addition to that, there's there's a capacity constraint in any given factory. And factories are expensive. You build the next factory, you've got to spend another multiple billions of dollars building another factory. So they have working capital costs, and those costs are real. You've got to find that money. That capital is real. You've got to find that capital somewhere. That's capital that, revenues come in, cost of goods sold. Then you've got all of your administrative costs, and then you've got maintenance CapEx, and then you've got growth CapEx on top of that. And that's like that those have typically been an anchor to these companies. And then when you're talking about distribution, it's one thing to distribute something in your local state. If you've got a little fast food franchise, it's doing really well in Los Angeles. Can we expand it to California? Can we expand it on the Western Seaboard? Can we expand it to the East? Can we expand it internationally? All of these steps it's not costless, and it's not easy to do. And each stage is a different set of challenges for managers. Software companies have nothing like that. They work on the one bit of software. Previously, Microsoft had to get the boxes of discs out to the retailers, and they had to sell them. They don't even have to do that anymore. And so they don't charge, it's not every 3 years, $300 for Microsoft Office. It's now whatever it is, $8 or $10 per user per month. And they just keep on incrementally improving it. And every now and again, you just get a little notification that you want to update this. Yes, I do. Now you've got everybody's got the same version of Excel, Word, whatever. So these are clearly different businesses. Amazon, faces some of those more difficult challenges that the older style businesses did as well. But they also have other things like AWS, which is basically, that's just going to scale for a long time. Google, again, more like Microsoft. Google might be the best business out there. So these things have grown enormously. And Amazon, I think, I forget the exact comp, but I think it grew 45% on a $100 billion basis. Now, that didn't exist in the data set until Amazon did that. So that's defied the base rate for these things. And so the assumption, I think, for a lot of these software companies has been, well, given that it seems that these things can just grow forever. And for all we know, they may very well be able to do that. And this may just be a temporary pullback. But they did seem to be exceptionally expensive. And I think that part of this is very low interest rates mean that, where previously you do have some challenges, even the software companies do have these challenges where they do have to grow that scale. It's not quite as simple as I was making it sound before. You do have to be able to, you need some capacity behind it. You need some support, and there's competition as well. Everybody wants that. The idea is you get that niche and you dominate that niche, and then you charge essentially whatever you want. So any amount of money spent getting to dominate that niche is money that is well spent. And so there's this race between these highly competitive firms to come to dominate these niches. And that's why it's fine to spend like a drunken sailor, to have negative free cash flows and raise money all the time. As long as you get to this point where you do dominate the niche, you can disrupt all of these old businesses that can't keep up. And so people have made lots of money investing in these things as they've run up, assuming that they will come to dominate the niche. Very low interest rates mean, you discount back all of the assumed success to today at virtually, very low rates. That gets you a very high valuation. It's really not much more complicated than that.
I think there's people listening who might not quite understand that. Explain that. Like, why do low interest rates mean like valuations can be higher?
Well, if we go back to that dividend discount model that I was talking about before, where you have the dividend, which is some assumed final dividend, it assumes that at some point these things will make so much money that they don't need to reinvest this rate, and you get these dividends back.
Okay.
And then you're dividing it by the G and the minus the R. So the R, because I'm Australian, I don't say my R's very well, but I'm saying R. The growth rate is the G. Okay. And the R is the interest rate. And so the discount rate. So what's the appropriate discount rate in a world where the 10-year is at 1.7 or wherever it is today, where historically it's been at 6%? Do you assume that we go back to 6%, or do you assume that it's 1.7% forever? If you assume 1.7% forever, or maybe even lower, or maybe even negative, then any sort of flow anywhere down the line with a very high G and a very low R. So if your G is 30% a year and your R is 1.7%,
so if you're growing by 30% a year and you're, the 10-year is 1.7%, like
that's a very high valuation. That's an infinite number. Yeah, you get ref. Right. That's right. So that the lower rates goose valuations, and they work, and basically falling rates goose valuations up, rising rates goose valuations down. And all of those factors together, you've got these businesses that seem to be, scale invariable or scale intolerant, whatever I'm not sure what the expression is, but they just grow forever at very high rates for virtually no cost. And then you have very low interest rates. And together, those two things lead you to a very, very high valuation. I think that's how we got here. I don't think it's irrational to have done those things on the data that everybody has.
I mean, that is right. That's kind of what we've seen. We've seen like companies grow. I mean, they're growing that top line. Some of the companies, it's extraordinary. I mean, the top line growth is extraordinary, right? And
astonishing.
Yeah, and we have a very low discount rate. When you do this, so let me ask you, what are you putting for your discount rate? What should a discount rate be with interest rates so low? Do you always go back to like the historical average, or do you assume how do you do that? Because that's something I'll push back on for necessarily always doing a DCF model or something like that. It seems like just so much guesswork, I guess, which obviously it is, but
yeah, I tend not to use them. I know that. So Buffett has tended to use 10% as his discount rate. He wants to pay 10 times or less. And I don't think that's a bad, and that's so that G, so you wouldn't necessarily, the R at 1.7, that's not necessarily the end of the story. You may build into that some additional risk. So you might say, well, 1.7% is the 10-year, but clearly these things are riskier than the 10 years. So I'm just going to assume 5% or something like that. Buffett has kept it at 10%. I tend to use this model that I think it's Buffett's as well, but Bruce Greenwald has discussed it in his updated value investing from Graham to Buffett and beyond. And he uses this method where he takes the two ways that you get paid by a company are the dividend that you're receiving right now, the yield, which includes buybacks and other things like that. And then he has this growth factor, which is the reinvestment rate. So you look at, to generate a yield, you have to have free cash flow. You look at the portion of the free cash flow that is paid out as yield, and then you assume that the portion that is reinvested is all reinvested as growth. And then you look at the return on invested capital, like what is reinvested in that company. And that gives you this, what he calls active growth. So the two portions of it are this yield portion plus this active growth portion. And then you just sum the two together, and that gives you the expected return for this business. And at no point in there is there any discussion of the discount rate. And the beauty of that is that it assumes also that there's no change in the multiple over your holding period. So I like to use that as one of the things that I just, is it reasonable that something that is growing at, if it's got this massive return on invested capital and it's reinvesting almost all of its earnings back in, is it likely that it can generate these very high expected returns? Yes, it is. And then you would take that number and look at the other opportunities that you have. Like, what is your opportunity cost for this thing? And say, how likely is it that it actually delivers this number? Because it assumes that it can sustain whatever return on invested capital it has. It assumes it'll keep on reinvesting like this. And when you compare that expected return with your other opportunities, you might say, well, it's worth paying up for some of these businesses. It might be worth paying up for, might be worth paying up for Shopify. I'm not saying that I think Shopify is expensive, but I just give that as an example of, I think that's a very well-run business, and it's got that quality that I described just then.
100%.
That's one of the ones that I always just struggle with a little bit, because I can see how good a business Shopify is. And I love the fact that it's like the distributed kind of Amazon, and each person who runs those little shops obviously cares more about those shops than Amazon does. You can go into Amazon and you can see many times like you're probably getting something that's a fake, or it's not as good quality. and they're competing with their own customers, whereas Shopify is not going to do that. I really like Toby Lutke. I really like that business. The only thing that holds me back is I just think that multiple is a little bit too high for me. But that's an analysis that I have done on Shopify, and I think it's a very, very good business. At some point, I'd love to own it, but I can't pull the trigger on it where it is here. But that's how I think about it. So there's no discussion really of what is an appropriate discount rate in there. It's more just what are my opportunities having gone through that exercise.
Okay. All right. So going back to like the big picture with the market, with what's going on now, the index hasn't fallen, but these high flying tech stocks have. Is this the reversion to the mean? Like you've kind of been, like, I don't want to put words in your mouth, but you kind of been, I think, as I interpret how you speak, like you've kind of alluding like this would happen for the last year or so, on your podcast.
To be fair, it's been longer than that.
All right. So let's get, last year or two, like you've talked about like the historical performance gap between growth stocks and value stocks is at this, like, it's at a very historical wide level right now. Like, are we reverting to the mean now? Is the carnage over, or like what's going? Tell me something good, Toby.
Yeah. So so just to go back before when we were talking about so I do divide the world into this idea of like the growth and the value, and the growthy ones are the ones that have those very high rates of growth, and they tend to be very expensive on a ratio basis, on a multiple basis, and the value ones are cheaper on a multiple basis. You can rank every stock in the market and divide them into, say, 10 portfolios of increasingly high multiples, and the lowest multiple portfolio, we would call that the value portfolio, and the most expensive multiple portfolio we would call the growth portfolio or the glamour portfolio. It's not necessarily growthy. Sometimes they're just expensive. Sometimes they're just glamorous companies.
Right.
So we look at those two portfolios and we compare the multiple differential between the two. So I'm just picking numbers out of the air, but let's say the value portfolio is on a multiple of 5, and on an average multiple of 5, the growth portfolio is on an average multiple of, say, 25, then the spread between the two is 5, because it's 25 divided by 5 gives you 5. And then we can look back historically. What did that look like in 2000? What did that look like in 2002? What did that look like in 2009? And you can see these changes as people change their preferences for growth or value over time. The widest spread that we've ever seen was 2000 at the very peak, March 2000 at the very peak, until recently, and we've exceeded that spread now. The really weird thing is that it was also exceeded. It got as wide as it has ever been in about September 2020, and then value did come back pretty materially, and now the spread is as wide again as it has ever been, driven largely by growth being exceptionally expensive. We've never seen these multiples in these growth portfolios before. So that's what I say when I say that the spread is very, very wide. What has historically occurred is that this is the way that value tends to work as opposed to growth. So what happens with value stocks is they're not as good quality as growth stocks. Growth stocks are better quality stocks. They've got better returns on invested capital. They grow faster. They are better companies. There's no dispute. If people, the whole way through this very long, painful period where value's been underperforming, people have been saying to me, why would you own these terrible companies when you can buy these better companies here?
Right.
And I would say that's
probably what I would say. I think that's
well, it might be. Well, the challenge is to buy the ones that are better than they look for less than you should be paying for them.
Of course.
And so the reason is that, like, that first order thinking hasn't been paid in the markets. Typically, what happens is you get paid for the second order thinking, which is, well, what do I get as an investor? It's not just trying to find the best company in the business in the market. It's trying to find the best company at the best price in the market, the best valuation, and which includes growth in there as well. It's not just the lowest multiple, but it has typically been the lowest multiple because we overestimate, we're too optimistic. So the way that value works is you buy these slightly less good businesses, but you buy them at a bigger discount. And then over time, the market recognizes that they're not as bad as the market thought. And the valuation over the holding period, the multiple over the holding period tends to expand. And growth stocks are the reverse. What tends to happen is the earnings do in fact go up over your holding period, so your annual holding period, but the multiple compresses, and the multiple compresses more than the earnings go up. And the value stocks, the multiple expands more than the earnings go down. And that's why value stocks have counterintuitively tended to beat growth stocks over the very long data set that we have, going back to sort of, I think we've got data now going back to like 1850 or 1825 or something like that, increasingly granular as you come towards the present day. And the best data starts in about 1963, its point in time. So what we can see from that is that most of the time and over the full data set, value has massively outperformed. But there are multiple periods where growth does better, and they can last for quite a long time. So the last one was 1999, 2000. And then we've got this one here. There are other ones. You go back to 1966, the electronics revolution, when everything's like in the .com 1.0, when you only had to stick .com in your name to get a really good multiple. You just had to stick electronics or tronics in your name, and you got a really high multiple, even if you had nothing to do with it at all, because that was the thing that was popular at the time. These things happen. These little manias happen regularly. There are 6 or 7 in the data set going back to 63 where value doesn't do very well. My opinion has been that we've been going through one, that this has been one as well, even though there's really no evidence other than the expanding multiples. But it just looked like all of the other ones. And I thought that at some stage that would reverse course. And it seems that it has sort of started in about September 2020. We have had this reverse course. It's not, I wouldn't say that it's over by any stretch of the imagination yet. The value spread is still as wide as it has ever been. It's just that the growthy stocks were so expensive. They've come in, and it's created that really unusual phenomenon that you were alluding to in the intro, where half of the stocks in the index, and it doesn't have to be the Nasdaq either, the same phenomenon is happening in the S&P 500, where a lot of these stocks are down, eye-popping amounts, 50%, 80%, and the index is sort of largely unaffected. The index, if you're a SPY investor, you don't even know this is going on. If you're a
passive index investor, right? You're just
if you're a software investor, you feel like you've been singled out, personally by God for some special punishment.
Right. So if looking back in 10 years, you said 10 years from now, you said in the 60s there was like an electronics mania. 99, 2000 was obviously the .com mania. How do you think this mania is going to be described? Like if this is a mania, and it is what you're describing, like when you go back, looking back on it, however long in the future from now, like, what do you think of, like, oh man, like, is it crypto? Is it like electric vehicles?
Well, it's the everything bubble, right? This is really the everything bubble. And I think that it's driven by the interest rates were just set below where they should have been set by any sort of sensible Federal Reserve over this period of time. And and I think it's been a successive series of policy areas, starting with Greenspan, and Greenspan who created the .com bubble, but then Bernanke, Yellen, and Powell. Every single one of them came into office, had that first, so that December, the 2018, everybody comes in. I think that was Powell, and they say, we can't leave interest rates here, like at zero or virtually zero. Plus all of these Federal Open Market Committee interventions where they're buying enormous amounts of mortgage debt and all of this crazy stuff where they had never done that before. And they've thought, what happens if we go into a recession or a depression? We're going to need to be able to drop interest rates. So what we need to do now is hike interest rates. And every single one of them has hiked interest rates when they first came in. Then the market has completely fallen over almost immediately, and they've all got spooked and just popped them straight back up again. So they needed some sort of, intestinal fortitude to see that through, and none of them wanted to be the one that tanked the market. So I think that's how we find ourselves in the situation where we are, where a lot of any reasonable person could really look at it and say, well, the stock market's at a peak, housing market is at a peak. Shouldn't we be also with interest rates that are a little bit higher? Like, why are interest rates stuck at virtually zero? This is about as good as it gets, isn't it? And then what's of course going to happen is at some point, these trees don't grow to the sky. The sand pile at some point, there's the grain that just makes everything tumble. And I don't know what they're going to do in that scenario. They might have to do what the Europeans have done and go to, negative interest rates, which I don't think that's particularly good for society when that happens. But the result of that has been, I think it creates people trying to escape the system, which is why crypto becomes much more attractive to people. You don't want someone fooling around with your money. And here's Bitcoin running up to 60,000, just having these absolutely monster runs. I think that it's had an impact on the stock market as well because of that dividend discount model. And then it's also made borrowing for houses as cheap as it has ever been. So provided that you had a house and you had some equity, and so you had a down payment, this has been a great time. Every year or so, you just go back and lower your interest rate on your house and pay less. Your house is worth more. You've got an ability to buy more. It's tough if you're stuck outside and you don't have the deposit, but for everybody else, it's been great. But there's really nowhere to hide. 60-40 portfolio, which has traditionally been the more the safer portfolio, 60% equities, 40% bonds, or the other way around. I forget which one it was.
Yeah.
That's going to be like a negative yielder for the future. So you're certainly going to get a negative yield in the index. You're likely to get a negative yield in 60-40. Housing's not going to protect you. I don't know where you hide. You don't want to hold cash because that's got no real return at all. It's a negative return at the moment because last time I looked, inflation was like 7% versus 1.7% in 10 years.
Just came in at 7%. Yep.
That means you're chewing up 5.3% of your capital every single year in your purchasing power. Like that's not very attractive to anybody. So I don't know where you hide. I don't think anybody's acting irrationally given the opportunities that they have. It's just that we're stuck in this system, and that's the way it is. And that's why we're here.
I'm sympathetic to a lot of what you're saying, but let me just push back a little bit. Like, so what changes from that though? Like if you call it an everything bubble and you say, well, interest rates are really low because every time a new Fed chairman comes in, they try to raise rates, and then as soon as there's volatility in the markets or bonds go down or whatever, housing prices go down, or as soon as they see any of that, they stop, right? And as soon as there's any kind of problems, and I'm granted, I mean, COVID was definitely a doozy. That wasn't like a small, like minor hiccup in the economy. But anytime something like that happens, they reverse course from raising rates and they lower rates, or they do additional stimulus. What changes, I guess? What gets us out of that cycle? Like what's to keep that on? I guess what's to keep that just from perpetually going on?
Well, this is one of the things that keeps me awake at night, is that I don't know exactly what takes us out of this cycle. I think that the James Montier, who's a market analyst, that's probably unfair to James. He's like a strategist or something like that. He's like a behavioralist, a value guy, writes for GMO. He wrote a paper, this could be 10 years old now, this paper where he said, he called it financial repression. You go through these periods of financial repression. We can find these, there's a few. There was one around World War II as well, where basically interest rates are very low and you get exactly this cycle. The thing is, it's just not natural. The system, at some point, something gives way in the system. And I think it's the same thing that happens every time. It's not necessarily interest rates that pop the stock market or the property market. At some point, it's just excess speculation pops the market. And I think that we've seen, there's sort of been this moving smorgasbord of bubbles in this market. And you can, crypto had a giant run, has had a few sort of run ups and then run back down. Software tech stocks have done it more recently. NFPs.
Electric vehicles. I mean, yeah.
EVs, yes. I don't want to say EVs because I talk about Tesla all the time. And every day I check on Tesla and I just think to myself, how is this thing still trading where it is trading? It makes no sense to me whatsoever.
We're already going to get enough hate mail from the Fed. So let's not badmouth Tesla too.
Don't send it to Matt, send it to me.
Please.
I've got a rule that just sends straight to trash.
So Okay, so I mean, a lot of the tech stocks are down, as we already talked. So, and the other thing I would push back on, I guess, is is that, yes, okay, we call it the everything bubble, and again, I'm sympathetic to a lot of that, but then I look at companies like Microsoft, Alphabet. I would talk about Apple or Amazon. I think any of those big tech names I can look at and say, I'm not going to argue they're not maybe a little stretched, but I also don't think they're completely unreasonable either. Like when you look at their economies of scale that they have, the profits they throw off, the free cash flow they throw off, and what we've talked before, but like I look for economic moats, and it's like for a lot of these names, like the larger they become, like Alphabet, the greater their moat grows. So what's to like, and if they make up, like, I mean, I forget the percentage, but if those 5 companies or so are right, yeah, 15% of the market or 20% of the market, whatever it is, like how can we be in an everything bubble if these companies? I would definitely push back and say they're not in a bubble.
I think that they are. I think that they are somewhere between. I still think they're expensive, but I think they're within the realm of being, like, if you think of valuation as a continuum, they're at the more expensive end of what is probably a reasonable range. I think last time I looked at Microsoft, it was on like a free cash flow multiple of about 40. So it's yielding about, on a free cash flow basis, yielding about 2.5%, but still growing rapidly. And so, it's not, I wouldn't buy it at this level, but I wouldn't necessarily sell it at this level either. It's sort of in that no man's land. The reason that Microsoft has had such a good run, though, like when you look at where you could have bought it in 2011, and I don't know if I talked about this last time, I've told this story a few times, but
that's fine. Yeah, go for it.
In 2011, it hadn't done anything since 2000 because it was way too expensive in 2000. But same thing, like it was still a great business then too. It just got too expensive, and it spent the next 11, 12, 13 years kind of going sideways. And in 2011, it had Steve Ballmer, was kind of regarded as a bit of a failed CEO, had this new CEO, Satya Nadella. Who's that guy? Like nobody knew who he was. They had the first year of revenue just kind of stepping back a little bit. It was their first little revenue decline after just, an unending series of revenue increases. And it got cheap. It was trading on a free cash flow yield of 11%. It's like a 9 times multiple. And then what has happened since then is that it's gone from an 11% free cash flow yield to a 2.5% free cash flow yield. So that, in addition, it's also grown its revenues and its free cash flow materially over that period of time. But that ski jump kind of look to it, a lot of that is multiple expansion.
Sure.
The question would be, will it do that same trick again over the next decade? And I would say the revenues could still keep on going what they're going, but at some point you get this sort of, there is this anchor to growth there. I think like at some point it becomes a material part of it's already a material part of the economy, but at some point, it defies logic in terms of its size. Having said all of that, maybe they just start paying up more of what they're earning, and the kind of the growth goes away a little bit, the multiple contracts a little bit, and you get that same scenario where in 10 years' time, it's roughly kind of where it is now. I'm not saying that will happen. I'm just saying that for a few of these companies, it's possible, because you remember that the 2000 bubble, everybody remembers it now as a dot-com bubble, but it was much more broad than that. It was a little bit more like a nifty 50 type bubble. Like GE had this massive valuation. Jack Welch was a genius. There were lots of these companies that were, we all agree they're really, really great companies. They were just so expensive that it was hard to see where they could grow from there. Walmart too, like Walmart's not a tech stock, and it was still a very, very good stock, still a very, very good business. It did the same trick. It sort of spent the next 10 or 15 years just kind of bumping sideways. And there are lots of examples of those companies that you just had to own them because they were so dominant, they were so good. I get the feeling that the same thing happens this time around. We're just sort of sideways for a decade. Certainly SPY, if you look at SPY, I know that the cape is very cool, or it's people don't like the cape. I think people don't like the
There's like some Twitter fights over this just this last
cyclically
week.
Adjusted PE,
Right.
which just takes an average of the last 10 years, inflation adjusts them, and then compares that to where we are now. People would say, well, that assumes that Microsoft and Google and Facebook and the biggest components go backwards, and that's just not going to happen. And so it's understating, it's overstating the multiple of the market to use the cape, and that might be fair. Like that's a fair criticism. It may not be as egregious as it looks, but there are other examples in there that it does seem to me that even if it's not 2,000 expensive, it is towards the upper end of what I would think would be a reasonable range. And the market just does tend to cycle between the upper end of a reasonable range and the lower end of a reasonable range. We just haven't seen much of the lower end of the reasonable range, probably for the reasons that we were discussing before. There's been a lot of interest rates are too low and there's a lot of intervention by the Fed. I don't know exactly how it plays out. I just tend to be, my approach is, the old Graham approach to the market was investment is the idea that you do some analysis and you make sure that you're going to get some safety of principle and then some reasonable return on top of that. And so that's my approach. I want safety of principle and some reasonable return. I'm not looking at it as an opportunity to kind of get rich. I think it's a great way of, saving into the market and retaining your purchasing power and maybe getting a little bit of return on top of that. That's sort of my objective when I'm investing. And it means that I typically don't participate in the more bubbly times, and I typically don't participate in the worst times either. Although, where if there's a big enough crash, if it becomes systemic, which I suspect this whole thing will become systemic at some point, it's just unavoidable. Everybody, they sell what they can, not what they want to. And the market just, they say correlations go to 1, everything sells down. That was the shock in March 2020, when I thought that we were reasonably protected in the value stuff, but the value stuff got hit harder than anything else. The average value stock was down about 50%, whereas I think the rest of the market was down about 35%. So that was a very tough time to invest through. I suspect the next time around, it won't be that way. It'll be the other way around. And on top of that, the other stupid little prediction that I think I wouldn't invest on this basis, but I just note that when I have observed market crashes in the past, they've tended to come about a year after the peak. It's just one of these things that the market goes sideways. Everybody thinks of a crash as being this sort of precipitous decline from the high point, but that's not what happens. What happens is there's about a year where the speculation just kind of churns and doesn't go anywhere. And the thrill seekers say, well, we're not getting the thrill here. We're going to move on from GME or AMC or the market or whatever it happens to be. And they tend to wake up about a year afterwards. And then it's 6 months of carnage to the bottom. And then we go back and everything goes back to normal. And we're kind of coming up on about a year. February 12, 18 is the peak for ARK as the sort of emblem of the more speculative end of the market. So when we come up to there, like I'm not making predictions about when stock market crashes.
No, you hear it here first. Like
is the dumbest thing that you can possibly do in the market. I'm just like, this is just one of the things. I wouldn't be surprised. I'm just going to be watching through that period because I kind of feel like that'll be the time that people will wake up and they'll look at their ARK statement and they'll say, well, we topped out at 156 on February 12th. And, we're below 80 or something today. And we're about a month away from where we're recording now. We're about a month away from that date. And I'll say, well, we're down 50%. Maybe we just take our money out and think about it. And that's what precipitates the sort of the big run. That's typically what it's looked like. I'm not predicting it. I'm just sort of saying I'll just be watching through that period with some interest.
All right, no, you couched out enough to like
good. I can't be wrong.
right. 50% chance. 45% chance of market crash.
60% of the time it works every time.
Right, exactly. Let me just ask you a little fun question. Like nothing we're gonna hold you to or investment advice, but there's a lot of names that are down a lot. If you had to pick between like some of the names that are down a lot, is there any that interest you right now?
Yeah, I haven't. They haven't quite come in to my hitting range just yet. Just because I care less about. I'm always more suspect of growth than I am of anything else. I'm suspicious of growth as a component of these businesses, and I think that the mistake that a lot of folks have made is thinking that these businesses will become Amazons or Googles or whatever the case may be. When the reason that we talk about those companies is because they're so rare. There's a handful of them, and even those companies had pretty big drawdowns on the way through. Even though we've spent a lot of this call talking on a macro basis, and it's my favorite thing to talk about. This is what I like talking about. But when I invest, I don't do it this way at all. I'm bottom up completely as an investor, and I'm always looking for something that has a good balance sheet, really good cash flow generation through tough times in the market, and good rates of reinvestment. And then I want a management team that is doing sensible things with that undervaluation, buying back stock. And I want a pretty tight correlation between the return on invested capital and executive compensation. So when I'm looking for those things, they're kind of a little bit idiosyncratic. It's not, I talk about value, but they're really, my definition of value is not that price ratio, price to book, or even, just any simple multiple. It's in addition to that, it's got to have some of these other qualities as well. And then I'm just trying to, the ones that I buy, I'm given fairly sort of conservative assumptions. Can I get a return that will likely justify the risk that you're taking when you buy those companies? And so they don't neatly fit into any of those buckets, although it's unlikely that they'll be in towards the growthier end. They just tend to be towards the more value end. But equally that, like we were going to talk about Lockheed Martin, and I have other stuff in there like Williams-Sonoma. Like they're just businesses that they throw off cash, they buy back stock, they've got good executive alignment, and they just sort of they never participate on the upside. They don't really participate on the downside. They just kind of muddle through, and that's basically what I'm looking to do.
All right. So look, we're talking about like the carnage in tech stocks and everything, and I know a lot of people like who follow Seven Investing are like, well, what is doing well in this market? And you didn't know we were going to show this, but like over the last year, your ETF, the Acquires ETF Total Return, it's delivered some significant outperformance here. So like, I think like the last time we talked on the Seven Investing podcast was like a year and a half ago. And, I feel like Michael Scott now, like where he's like, oh, how the turntables, or whatever that quote is. But like, to your credit, since the 1st of January, 21, so a little over a year now, the Acquires ETF has given investors a return of like over 10% over the S&P 500. So let's talk about this. Like, I think last time you're on, you said you described your investment approach, which you kind of just went through. You kind of just said that, but you said it was quality at an unreasonable price.
There you go.
Is how you described it. Quality at an unreasonable price. And you kind of just went through what you look for. You have a strong liquid balance sheet, a robust business capable of generating free cash flow, like a discount to like a conservative valuation. So let's just talk about like some names. And like you already mentioned Lockheed Martin, and we've talked very little about that, but it's a name we both like. So what do you like about Lockheed Martin? And that's in the top 10 position in your portfolio, I believe.
Yeah, it moves around a little bit because I tend to rebalance back to equal weight on a quarterly basis. And I'll just, when folks go and check out that chart, make sure you run that all the way back to the date that I launched, and you'll see that I'm underperforming the S&P 500 through that period. So I haven't done any victory laps because I had a good year last year, because I'm still lagging. But that's because, what I think that what I'm trying to achieve is that, reasonable return of the stuff that I own, given the risk that we're taking. And we have gone through that period of the market, which was much more favorable to growth. And that was pretty hostile to my style through that period. So I'm very happy about, this. I know nobody's going to believe me when I say this, but I did say this to my wife at the time, that when we were underperforming, and by a pretty wide margin, I did say, as much as it sucks to underperform, like, I'm heartened by the fact that it is doing what this thing should do, which is it is tracking these value positions. And when this turns around, I want it to track, value again, because I do think that over time, value does tend to outperform. I think that, there are reasonable arguments on the other side where people say, well, all of this stuff it's too simple. Computers can do it, and you'll just be front run by computers. And it's also the most popular kind of form out there, and everybody likes to pile in. Although I don't think it's that popular anymore. It's certainly not that popular right now in the market. But I do think that, I'm trying to manage for a full cycle, and I'd like to be judged on a full cycle. And I don't think we've seen a full cycle. So my cycle will be sort of closer to the top on the other side, which will include, we're going to have a big drawdown at some point. We're going to have a run up the other side on the other side. And then we're going to get closer to the top on the other side. So I think that I would like to be judged on a full cycle, which is out 10 years. In any given year, it's what a stock price does is just totally random. I have no idea what the stock price is going to do. The way that I gauge whether I'm doing a good job or not is, am I buying stuff that keeps on doing what I thought it was going to do after I bought it? And if I get the multiple compression through there, then honestly, I don't really care. I've said this a few times. I said this a few times.
Right? I mean, you have to tune that out. Like, there's no way, if you're going to live and die by like short-term movements, you're just going to drive yourself crazy.
I said a few times on my own podcast, I just don't care that the price is going against me, because I can look at the underlying businesses and they're doing pretty well. And I got a few people who sent me emails who said, I'm an investor in the ETF, and I wish you cared a little bit more because it's not working. So I want to be completely open about that. The performance was shithouse initially, and it has turned the corner, but it's kind of tracking that value cohort. And so that's how I'd like to be judged. When I said, the other thing that I often get, the other criticism I often get is that someone says, well, you said deep value, which is, and now you're talking about quality. When we wrote quantitative value, which came out in 2012, we used, that we were using, our analysis was of all of these fundamental measures that industry and academics had come up with for measuring the valuation of a business. In 2013, AQR wrote this paper called Quality Minus Junk. And so many of those factors that I considered value fundamental analysis factors got pushed into this quality bucket. And so I've had this debate on stage with Jim O'Shaughnessy in New York about 5 or 6 years ago. And I've said this a few times since. I think, the quality value distinction, to make value distinct from quality, I think is a little bit silly, because it means that value is purely this sort of price to book multiple. And we all know the problems with price to book, where what we're all trying to do is trying to buy better, trying to buy more value, or, more quality value, which is the way that it's defined now, for less than it's worth. Basically, we're all trying to do the same thing out in the future. And so I'm still doing what I've always done, which is trying to buy some chunky value, but now that's described as quality. So it's still quality at an unreasonable price, or deep value. It's all the same thing to me. So with all that said, so Lockheed Martin, I think Lockheed Martin is interesting because they do follow this cycle where a new president comes in, and these things tend to sell off a little bit because nobody knows what the new president's going to do in terms of defense spending, right? They always worry that there's going to be some trimming to defense budgets.
Right.
And that's going to impact something like Lockheed Martin. No president has ever reduced the amount of money on defense spending. And this one didn't either. And so
not only that, like when he submitted his budget, Congress came back and was like, and upped it and said, no, it's not enough. We need more. So, I mean,
can you imagine being the president who lost the empire, lost the superpower status because you didn't put enough money into defense?
Right.
No one's going to be that silly. You're just going to spend more on defense. So when you look around at the beneficiaries of defense spending, probably one of the very first names on that list is going to be Lockheed Martin. And so I like Lockheed Martin. I think it's very well run. At the time that I put it on, I haven't actually looked. I didn't prepare Lockheed Martin specifically for this call, so I don't know exactly where it is right now, because I don't don't tend to track them as closely. Not tracking them on a daily, weekly basis, just tracking them when they file. Sure. Last time I looked at it was like a 5% free cash flow yield. I don't think it's moved much since I've held it. It might be up like 10 or 15% or something since I bought it. It's not much, which is essentially noise. Like if it was down 10 or 15%, I'd still consider that
100%,
noise.
100%.
So got a pretty solid dividend. Dividend's 3% plus.
It's right about 3. I think it's like almost right on the money, 3.
So it might have run a little bit in my favor if that's the case. So market cap last time I looked was a bit sub 100. It might be around 100, coming up on 100 now.
It's almost exactly 100. Yeah.
There we go. And revenues were like 67.5, might be pushing up on 70, something like that now. Do you have those numbers in front of you? I don't. In fact, so just going by Morningstar, like I've just brought up the real quick overview. Forward dividend yield 3.07%, market cap 101 billion. So it's pretty much right there. Roughly around there.
Yeah.
The thing that I really love about it, I don't know if you can pull up the share count over the last 10 years. The share's been reduced by 17% over the last 10 years. So that's something that I really like to see, that sort of discipline about shareholding. Now, I know a lot of people will say that they will pull up. Evidently, there are studies that say that issuing a whole lot of stock is okay. I would say that there are probably more recent studies that are looking at tech stocks that have run up, despite the fact that they've been issuing like 15% of their share capital in options every year. And sometimes they go do a little, little fake buyback that basically mops up their option issuance. And so that is not properly captured in those analyses. Sure. I just think about it like, as a business owner, if I think something's undervalued and the business has the free cash flow or the cash on the balance sheet to buy back some of that stock and concentrate that value for me further, with me not having to do anything, that's the ideal scenario. It's much more tax efficient than paying out dividends. I would much prefer that they cut the dividend to zero and spent all the money on buybacks. Now, there are folks out there who like dividends. And they're going to scream at that. And there's no way in the world that Lockheed Martin or any of these companies are going to do that. So don't worry about that. It's just my personal preference. From a tax perspective, it would be more efficient to do it that way. So I think that they've done a very good job there. They make all of the brand names that, they make the F-35, they make the Sikorsky, they make mission systems. They're there for missile defense, they're in space. Yeah. They're doing all of this really hard stuff that you just can't, there's just no way to compete. There are competitors there, but there are no new entrants into this. I get that. I get that SpaceX is a new entrant in some of these respects, and I think that SpaceX has been an explicit project by the US government to create another launch system that can do some of these things that will keep these other guys honest, so their spending that doesn't get out of control. But there's still, SpaceX needs a lot of support from the US government, needs a lot of support from the Aerospace Corporation to do what it does. Lockheed Martin, all of these guys are the same, but they're like Lockheed, it's hard to compete with these guys. They're going to earn a pretty reasonable return. No government is going to let these guys go out of business. No government is going to let these guys earn anything less than a reasonable return. They're going to earn a reasonable return. And at this valuation, I think they're slightly undervalued. So you're going to get that. I think that you're probably likely to do a little bit better than Lockheed Martin does. And in this market, there just aren't a lot of opportunities around like that, where it's pretty certain that you're going to get that return, and it's at a reasonable discount. I think over like a period of 5 or 10 years, it's like a mid-teens kind of return, which is about my bogey. So I really like Lockheed Martin. I think the management does a good job. I think the business is pretty solid. I don't think you can compete very easily with it. And they do all of the right things. They pay out the cash flow. So it's one of the things that's squarely in the hitting box for me. Not going to make you rich, but reasonable to save into it at this point, I think.
Right. Yeah. Like, I mean, if you're listening to the podcast and not watching, I've been violently nodding my head to most of what Toby's saying. But like another way too, is like, just imagine so Lockheed Martin makes the stealth fighter jet. A company would have to come in to try to compete for this contract. Like, we have to dedicate millions of dollars, billions of dollars, really. Yeah. If not more, to develop like a working prototype. In a technological field where I had little experience, and all for a slim chance of winning that contract. And then if it failed to win that contract with the Department of Defense, all that time and money would just basically be sunk cost. And there's little to no commercial applications for that. You know, you have to have a very highly skilled workforce that also has to have security clearance. And that's also willing to work on things that, like, ultimately at the end of the day kill people. You know, that's a small like group of people, you know, who can meet all those things, you know. So it's just like, so the Department of Defense, like, you know, in my mind, they're not gonna, like you said, they're not gonna let Lockheed Martin go out of business. But even more than that, they're not gonna like let Lockheed Martin even have to go through like huge layoffs or anything like that. Where now this workforce that's highly skilled, willing to work on weapons, passes a security clearance, and now they're just being scattered to other technological engineering companies. You know, like, I just don't see the government can't do that, right? Like, I mean, a politician, it would be like it would be such a folly if something bad were to happen, and to have that happen under your watch. Like, I just don't see how like the U.S. government would allow that.
It would be a colossal mistake.
Yeah.
Governments make colossal mistakes all the time, but it would be a colossal mistake. And it's just unlikely that something on this scale happens. Not zero, but, you know, equally, you're not going to be, it's not going to make you rich, something like this either. It's one of those things that it's just going to plod through.
It's not a get rich quick scheme, right?
Right. But I'm at this point where I just want, basically, I'm more worried about getting my money back than anything else. And then I want a reasonable return on top of that. And I kind of think that this is the sort of thing that does it. Williams-Sonoma is the same kind of idea. You know, Williams-Sonoma is nothing like Lockheed Martin. For one thing, it's like an $11 billion market cap, and they sell French kitchenware and other stuff like that.
Right. A little different
under a few different brands, but, you know, same kind of idea. Like, I do think that that's pretty. They're pretty good representations of what I'm trying to achieve. And a lot of the stuff that I buy some other stuff too. That, you know, so I own O'Reilly and AutoZone, and what those guys, the attraction to those things is they've been serial acquirers of their own shares for years and years and years. And you can see that businesses that do that on an opportunistic basis, so when they're undervalued, they buy back their stock. That has this over time, that has this incredible impact on the value of those companies on a per share basis. And that's what we should all really care about. What's the value doing on a per share basis? And so that's kind of what, you know, in a nutshell, they're pretty good representations of what I'm trying to do. Good balance sheets, lots of free cash flow, using it to buy back stock when they can, and management sort of tightly aligned with shareholders.
Absolutely. Toby, let's wrap this up. I think we're coming up on time. Like, where can people find you if they're interested in more about, like, following you?
My firm is Acquirers Funds. It's this logo behind me, acquirersfunds.com, and it manages two funds: Acquirers Fund, which is mid cap, large cap. It's all US domestic equities, and the Deep, which is small and micro. They're exactly the same kind of strategies, just in two different universes. And then I have a website, acquirersmultiple.com, and I'm on Twitter at greenback.com. If you go to greenbacked. If you go to acquirersmultiple.com, you can see I've got some books and a free screener, and we do a podcast that you alluded to before. We just talk like this all the time about value stocks and about what we think the market's doing. A little bit of like macro value, I guess, if you think about those market level valuations. But yeah, it's fun. I really enjoy doing it.
It's fascinating conversations you have every week. I look forward to that, the Value After Hours show. Again, like, definitely check out his podcast, check out his website, check out his ETF. Toby, thanks so much for coming on today.
My pleasure, Matt. Thanks so much for having me. I always enjoyed chatting.
Absolutely. So again, I'm Matthew Cochrane, lead advisor with 7 Investing, and we're here to empower you to invest in your future. Have a great day, everyone.